If you ever want to have a spirited conversation with somebody about trading, pick a side in the breakout or pullback debate. Sometimes I feel that trading methods and just everything with trading has become as partisan as politics. One side thinking that their side is the way that you should be going. But the truth is, this is not an either or situation. Before we get into it, if you're trading stocks or you're looking to start trading stocks, a really great way to do that without trading the actual share is through options. This guide is free. Download it. Links above, links below. And just see if something piques your interest when it comes to trading options. All right, let's get back to it. Here's the facts. You can trade both breakouts and pullbacks with an understanding of the pluses and the minuses that are associated with each one. Now, details matter. And when I say trading pullbacks, I actually mean the reversal out of the pullback, because if you're trading the pullback, that's actually a mean reverting strategy as you position against that main trend. And it's funny because I'm always learning as well. And as someone on YouTube, I believe, that commented on one of my videos, asked that question a month ago, which made me want to rethink how I talk about trading pullbacks. So it's about trading the reversal out of the pullback. Now, trading breakouts, that has a whole bunch of different meanings, but really one is more accurate, and we'll cover that in a minute. So let's just simplify what are pullbacks and what are breakouts. Here's two simple definitions. Pullback, just a corrective move in price against the impulse move of the main trend direction. Right? A pullback is classified as either one-legged, which is a simple correction, or two legs, which is a complex correction. We're talking about breakouts. That's when price breaks a support level to the downside or a breakout of resistance to the upside. Now, your pullback is taking advantage of the evolution of price. Price moves in waves. We call them impulse moves and corrective moves. Like you can see here on the left, the market moves up, eventually it rolls over into a pullback. And at some point, price is going to attempt to head back into the direction of the original move through some type of reversal. The breakout occurs when a defined support or resistance level gets broken by price. Now, there's times when price does not alternate between impulse and corrective swings. It simply trades between two levels. However, on a lower time frame, it will actually be a trend. That's a video for another time. But this is often described as the accumulation, buying, or distribution, that's the beginning to sell, of a market. Now, this buying and selling is done in a manner and at a volume that does not move the market enough to facilitate a trend move. So how can we discuss the pros and the cons of each of these? Because you don't need someone to tell you which one to trade. Because once you know what the failure of a pullback or the failure of a breakout is, you can decide for yourself. And again, remember, it can be both. So let's talk about a pullback. How does this fail? When a trader sees a pullback in a strong trend, the expected outcome is a reversal back in the direction of the trend. But there's going to be times that something else will happen. Momentum will move in the direction of the pullback, right? So where that happens matters. But if we start seeing big move against the main trend, that's a problem. You could see price pulling back, and instead of reversing, it just goes flat. The other one is price will reverse, but it doesn't make a new high. Now, each of these is going to present a different issue for a trader deciding which trade to focus on. So momentum against the trend. Here we have a steady uptrending market. Started off as a decent pullback in price. I just use a simple trend channel to show how that at that black arrow there, price broke the rhythm of the down move with momentum. There's no lower shadow either. A lower shadow would have shown you that buyers were stepping in, which they did not here. Now, if you're trading with pullback entries, this is probably one you would take off your list. So when price goes flat, this is when price begins its pullback, and instead of reversing, it just goes into a trading range. So here we have 3 days of a down move in price. You get a reversal candlestick. It's legitimate. You trade that. But instead of price reversing and continuing the uptrend, price goes into a multi-day trading range. Now, if you went long on the break of that high of that reversal candle, it could be a painful trade to sit through. You probably would not got stopped out on this trade, depending on where your stop is, obviously, which should be below the low of that reversal candle. The other one is the failure to make a new high or a low for a short trade. So here we have a trending market. We expect price to continue to trend up, which means making higher highs and higher lows when we're talking about an uptrend. But once price fails to do that, we can actually consider that's the start of a trading range. So here, pullback has small candles. It's a good pullback. It even has lower shadows, showing that there's some type of accumulation, some buying at these prices. We see that reversal take place. Price stalls right near the resistance level. Now, once that inside bar forms, this is a true bearish candle closing at the low. You would want to adjust your stop loss order to exit at a break of the low or just get out. Now, depending on how you take profits or manage your trade, this trade could have actually taken some money out of the market. So what would you do? The best thing to do is go back over these three examples. And even though you know how they already turn out, where would you have entered these pullbacks if you would have? Where would you have placed your stop loss? Now, remember, the pullbacks are going to come in all sorts of different formations, right? So don't get bogged down in looking for that perfect pattern, because all we're doing is looking at a natural pause in market action. We're looking for a reversal entry, expecting further continuation. But as you just saw, that fails. What about breakout failures? Well, once you can define a horizontal support and resistance level, you can actually consider looking at trading ranges and breakout trades. Now these, like the pullbacks, are just how the market moves. Now, details. So some are going to call these failed breakouts. But if you want to be exact, price did break out of the range. The breakout failed in the direction of the breakout. It didn't fail to break out. Some might say that's a stickler for details, but it matters. Now, price breaks that's above these defined levels for a long trade. That's the breakout. Traders generally will use buy stop orders at these levels when looking for a long trade. This is a great example of a successful breakout trade that ran 22% from the breakout to the highs. So a trader that bought when the price broke resistance level, that's a good move. So at these levels, you will find it can be extremely volatile, and they don't all look this perfect. Now, if you're taking trades at the breakout and price fails to run and turns in the opposite direction, we have a failure. A breakout will fail by price convincingly coming back into the range after a brief excursion outside the levels. Now here you can argue that that first failure can actually be an entry into a breakout that you expect to continue to the upside, and that's true. We call these failure tests. These can be an excellent entry into a trading range where you position before the breakout, or if you trade the range itself. Here we have a great example of a volatility at the break and a perfect failure of that breakout. Right? So this is where price has convincingly came back inside the range. Now, although we see that basing at the top, right, that's constructive for continuation long. So I want you to think concepts, right? I'm not a fan of that large candle that broke the highs, but that basing, that's good to see. However, sellers left no doubt that they wanted to see it back below pre-breakout levels, and that's where it went. Now, breakouts can fail back inside the range. They can fail in the opposite direction, or they can form a new range outside the original breakout level at a new area of support, right? Where resistance becomes support. Now, I'm not going to get into stop losses in this video, but you can learn more about setting stop losses and how to trade ranges here. So which one's better, breakout, pullback? This is not a this or that answer. In fact, you can use both as part of your trading strategy. So a breakout strategy that incorporates a pullback strategy is actually the best of both worlds. Now, most traders have heard that trading the first pullback after a breakout is a good strategy. So if you use what we just talked about in the pullback section, it's actually a very solid trading approach. The chart here, how do you play this? Well, the trader defines a trading range. You can see it. Price breaks out of the range, showing that, at least in the short term, we have momentum in that direction, which is upside. Price pulls back in an area around the breakout level. Now, it doesn't matter if it comes back in a little bit, right? You think about how the market moves, buyers and sellers, right? this kind of move here could be expected. And now traders are going to use their techniques to find an entry price. And it actually may be a better price than playing the actual breakout, as you would see in that chart right there. Here's another example of a breakout pullback trade. And as you can see, there's a lot of merit in using breakouts to set up a pullback. Okay, while there are other ways to trade around the ranges, this method is my favorite way of handling breakouts. Will I miss a trade? Absolutely. But there are plenty of instruments that I can trade. So how else can you combine a pullback and a breakout? One of my other favorite ones is using a breakout as an entry trigger for a reversal from the pullback. Sound confusing? Let's check it out. In this example, the small box is a higher time frame pullback in price. Using a breakout into the pullback uses a lower time frame. So here, price puts in a test of the swing low, buyer step in. Okay, this is an entry, although this is not the breakout entry. You are positioned before the breakout. At the top of the channel, price closes above resistance. You enter. After a small retrace, price gaps up higher. Now, one benefit of using the breakout as an entry into a higher time frame pullback is the ability to set a bit tighter stop. A tighter stop will allow a larger position size, and if momentum steps in early, you can adjust your stop. I actually find this to be a better risk management strategy because I can reduce risk when seeing momentum on the lower time frame. And I will take a small loss if I'm too aggressive because of the lower time frames. So it's always key that you read what the price movement is telling you. So as you could probably guess, I suggest that you take a look at both ways of trading. Use them together. Now, there's some discretion, of course, right? How you draw your support and resistance zones will matter when you're looking for breakouts. What does a pullback look like to you? All right, just a warning, don't get caught up in looking for a perfect formation that could look ugly. Are you going to use volume or a momentum indicator to gauge price movement? Are you going to use other forms of technical analysis, such as a candlestick pattern? All of that has to be decided before thinking of using real money in the market and committed to a trading plan. Above all, on each trade, do not risk an amount that will drain your trading account when the trade goes against you because you are going to have losing trades. All right. Thanks for watching. Hit like, hit subscribe. Any questions, pop them below. And as you know, I will respond.